Good evening, everyone. We are about to start. Please let me know if you hear me well. Perfect, perfect. First, I owe you an apology for 2 weeks ago. Our first seminar was with a horrible sound. We couldn't even load it to YouTube or fix the audio. So I'm very sorry for everyone that were waiting for the recording. But today we've done our proper preparations and we're good to go. There's a good amount of participation today, so we'll be right on starting. So good morning, US, good evening, Europe, and good night, Asia. We'll continue with our second part in the series of order flow scalping techniques. And for those who weren't around last week, we'll do a fast recap. And so you'll be in the business. We'll put this webinar on recording. And so you can always return to the material that we're going to cover. So let's start on. Okay. So what we'll talk about today, we're going to cover a scalping technique that is based on pole and flags. Poles and flag is a very common price action candle pattern, and we'll learn how to analyze, learn the anatomic of the flag and poles and see where we would like to enter our trades, how we are going to manage our risk, how we're going to plan the trade in the most efficient way. And we'll do a very fast recap about what is order flow and what is the basic understanding that is needed in order to find the right way to trade flag and poles, and also understand what are flag and poles in terms of order flow. What does that mean on the other side of the exchange? Then we'll cover some trade ideas of how we're going to scalp, but remember that scalping is a very tricky issue. In scalping, we're looking for taking very few pips from the market. And in that sense, we are risking much more because we have spread, we have the cost, we have price that might go against us. So we must know what are our odds in the trading, in what is our statistics. So it's not going to be very easy. Don't take anything that I say today right into real life market. Practice first, see that you have good understanding, and we're going to talk about what is the probability expectation that you need to have before you actually take it to live trading. So let's continue. First thing about myself, my name is Gil Ben-Hur. I'm trading for 40 years, specializing in Forex. I used to be independent trader for many years. I used to manage private portfolios for private clients. I was a partner and a master trading educator in a very large community with premium education program. And since 2016, I've founded the5percenters.com, which is a funding, traders, and growth program for Forex traders. What we do, we fund traders that are consistent and know how to make profits. If you are interested to see what's our program is all about, hop into our website, the5ers.com. And if you have more questions, you can contact us by email, chat, whatever. Let's go and do what we are all gathered here to do. So when we are about to scalp, we are looking for a very high probability exit signals, because when we are looking to skin the market with very low pips, we actually risking much more than we are about to take. So when everybody learn to trade, we are being taught to look for 2-to-1 risk ratio, 4-to-1 risk ratio. In scalping, it's the other way around. We are risking more than we are willing to take. And for that, you have to have a slightly different state of mind. You have to first know that you are going to take whatever you decided to take, because you cannot risk holding on your trade longer than that, because you are relying on high probability. You are relying on being right in the market much more times than you are wrong. You have to have a very tight trading plan and risk management definition, and the stop definition, where you getting out of the market when you stop trading. This is very crucial element in your trading plan. So it's very, very important that you understand that when you are approaching scalping. Here is something that we've covered in the last session. If you will be asking, we will dive deeper into this. But this is an Excel sheet that actually calculates what would be the break-even situation in terms of risk ratio that you take on your trading. And I'll give you just the conclusion, because we've gone through this in our last session. But when we are trading negative risk reward ratio, when we are trading a negative risk reward ratio, meaning that we are risking more than we are willing to take. Let's say we are risking 4 times more than we are willing to take. We have to, in order to be break even, okay, just to not lose money in the market, we have to be 80% right on our trading. So that is pretty much a lot. For that to achieve 80%, we really have to be patient and be very concise with our entry signal strategy. So what we're looking for in our scalping plan, I'm looking for 3-to-1, meaning I'm going to risk 3 units for every unit that I'm willing to take. Let's say it's 15%, then I would risk 45 pips, meaning that out of 4 trades, I'm expecting to win 3 times and lose 1, just in order to be break even. That's 75% accuracy. So if I'm having, if my statistics is above 75, I'll start being positive in my performance. So this is to cover this. I can, if you would like this, I can cover this in more depth in our next session, but let's move on. Right. Okay, so let's start talk about some theory. Flag and poles. What are flag and poles? There are three types of flags and poles patterns that we're going to discuss today. And this will be the basic of our terminology. First, in terms of order flow. If you remember, order flow is the order positions that are waiting at the exchange, and this determines whether price will go up or down. This is the array of all traders that are willing to buy and willing to sell in the market. If there are an even amount of traders and sellers, meaning people are asking, demanding the product, and people that are willing to sell the product, which is supply, providing the supply, if the amounts are similar, then price will range, will stay at the same price. However, if one party will exceed the other, if there be more demand for the product, then price will go up. If there be more product than demand, then price will go down. This determines the core essence of how price is moving, regardless of any manipulation in the market. Manipulation that happen in the market are manipulation that actually inject orders into the market in order to create different price movement, but they are always based on real demand and supply that is in the exchange. So when we see price pattern, we're actually reading a story of what are the historical, the chronology of the order flow, the orders that were injected into the market at any given time. So if we see price is coming up very fast, that means that there were much more buyers willing to buy a product than there was actually supply of that commodity, right? So price would go up until there are enough people willing to sell, and then price will be basing at a very tight range, which is also called consolidation. So here price is come to an agreement, and there were enough buyers and sellers at the same time. And then when price continue up, this means that there are less people willing to sell, so price will go much to higher prices before they meet more sellers in the market. Okay, so the basic understanding of order flow is that when price is actually breaking out a level, when price is actually breaking a level, we can assume that there are some people, some buyers in a scenario where price is going up. We can assume that some buyers were not being satisfied. They didn't get their sellers to actually match their orders in the market. So we assume that at this position where the breakout occurred is where many buyers didn't find a seller for the other side. So their orders are staying there and waiting for price to return back to this point. So this is the basic concept for supply and demand order flow trading. And using this very simple concept that is really easy to understand, we can talk about many different patterns, and we can explain almost every price action pattern that we can see on the chart. So the same thing also apply for downtrend. Of course, we don't need to cover that. Okay, so once we see a flag and pole, we have three types of flag and poles. We have a pole, and then price is flagging, and we call it a pullback flag when price is actually flagging downwards. And then when it pops up again, then that would be the pole, and we are waiting for another flag to establish in a later point. We have another different type of flag, which is ascending flag. This is the pole, and price is still climbing up, but in sort of a very slow way, and then the breakup occur and another flag is emerging. And we have an incomplete flag where we see that the pole is emerging, and then price is consolidating down and breaking, but not actually breaking the top. So once we have this situation, the flag can be very long and it's not actually completed. We really need to understand the incomplete flag, because we don't want to trade where we don't have a conviction for the flag to be actually completed. If it's an incompleted flag, then price may continue this and we're not going to be on the right trade. So the easiest way to understand this is that if there wasn't a break of the top of the top of the pole, then the flag is incompleted. Okay, and it's very important to understand that when we're trading flag and poles, we are trading historical formation of chart, and we're going to use that information in order to trade in a real time. So let's discuss the pole and flag anatomy. So we have the flag, the pole, we have the flag body, and then we have another pole. When the flag is completed, it means it was the top of the flag was broken. It was, and we distinguish three types of levels that are important for us in terms of what we're looking for in terms of scalping. One is the breakout level. We take the top line. We always use straight lines, horizontal lines. Okay, we take the peak of the top of the pole if it's a long bias, and then we mark it, and this would be the breakout level. I call it BO. We also have the origin of the pole, the origin of the next pole, which is actually the dip, the lowest point if it's a long, a buying pole and flag. You just imagine the other way around if this is for short. Okay, so we call it the origin of the pole. So that's another key level that we are going to look up for. And then we have a decision point. A decision point will be more familiar for those who are experiencing with supply and demand trading. We covered this in our last session, so that will be, I'll show you in a second what is the decision point and how to find it. But supply and demand, go to your resources, look up for supply and demand, and you understand what is the decision point. I'll show you how it's look on the chart. So here's a sample from a few days ago. I think it's the Kiwi, if I remember right. So this is how it's look in for real. So we have a pole from the very origin to the highest point. That would be the pole, and the retracement would be marked in this box from the very top to the very low, and from that another pole was originated up, and then price was bursting up, and another retracement. That would be another flag, and another flag, and another flag, and another flag. And you can see that there are many variation of the formation for what is a flag. A flag can be going very deep. It can be very fast, and it can be very slow. And here we can see that there is an incomplete flag, and price after that are making some sort of reversal. Okay, so this is how flag and poles anatomy look like. And the key levels that we are looking for are breakout levels, the region of the pole, and the decision point. So let's talk a little bit about the risk management. When we are trading, we want to take our position in a way that we have enough margin for error, meaning that we are wanting to trade many trades with low risk, with low leverage, because we never know if we're going to have a good or a bad day. We're looking for trades that will determine 3 risk to win ratio, meaning that we're risking much more than we are willing to take. In my trading plan, I usually take 45 to 30 pips risk, and we should have some sort of a stop loss to break even strategy. Everyone can choose their own where to become risk-free on your trade, and I take a definite profit at 15 pips. This is what I expect to take. This will provide me enough pips for what I want, and I need to have greater than 67% being right in the market in order to actually be profitable in such risk management plan. So what I want in this specific trading plan, first I want to take 15 to 20 pips as winners. I don't want to have more than that. I would risk about 45 pips for taking these winners. I going to looking for price range of that is 4 times greater than what I'm willing to take. So I would expect to see a pole with a range of about 40 pips before I expect to take 15. That makes sense. That means that I have to analyze my flag and poles on 1 hour and up time frame, sometimes M13, if it provides the right range for this. Okay, and I have to be right more than 67% rate, and we'll also cover this last time, or just a quick recap. Our daily target, it's very important when you're scalping to take a daily target and to have a definite definition for when you're stop trading on loss, on when you win. Don't overtrade. Don't try to revenge the trade. Accept bad days. Accept winner days. Don't get overexcited. Don't get just stop when you get to your target. Okay, so being specific to polls and flags, what I would be looking for in terms of polls and flags, I'll be looking to trade pullback flags. They are the easiest to understand. They should be, if there are pullback, they should be always completed flags, not incompleted flags. I use high time frame flags on H1 and up, whatever they are, and I mark their levels. I'll show you in a second. And for entries, I'll be having three types of entries: the breakout level, the region of the flag level, and the decision point level. The exit on loss, my stop loss, will be always few pips beyond the origin of the flag. Okay, so if you're willing to take the origin of the flag, then your risk will be very, very tight, very low. If you take the breakout or the decision point, you would have you have to allow price to go lower than that, and you might suffer sometimes in being in a drawdown before conviction if the market goes with you or without you. We want, in order to achieve a high success rate, greater than 67%, we have to play with odds. We have to know what is the market bias. We have to understand the direction of the market in terms of multiple time frame. When we look at the charts, we want to see enough range that will provide us enough pips to take. We're looking for, of course, for retracement, and that the story is concise among different multi-time frame. Okay, so let's change to charts and start playing with charts. All right, so here is cable H1 hourly, and here is how I mark flags on the last rally of H1 starting July 19th. Okay, so here's a flag from the very low. It can actually be from here all the way to the top. The retracement from high to lowest, that would be our flag. And again, another pole, the region of the pole, high to low, that would be the flag, the pole and the flag. From the region and up, that will be the pole and the flag, and again another flag. And here we are now at an incomplete flag. This whole flag that we're seeing, it's incomplete, so we don't have a definition for what price is going to. But what are the levels that we are looking for currently? So let's work specifically on this flag. On the very top, we have the breakout level. That breakout would be a place where we would want to try to buy the market and try to take our 15 pips or 10 pips, whatever your definition of profit would be. The lowest line will be the origin of the flag. The origin of the flag, of the current flag, it's not marked, let's mark it. The origin of the flag is from here to the top. That's the flag. So the region would be trading from here, buying from here, and stop loss can be very, very tight, only a few pips below that. If price go down, then probably this won't work at all. And then we have another level, which is the DP, the decision point. The decision point is, let's remove this. The decision point is, if any one of you is trained to spot the, supply and demand, you would understand what decision point is where price is start rallying and it's concluded in breaking out. So that's the origin of the movement that actually broke that level and gone up. Okay, so now let's explain in terms of supply and demand why these three levels are the hot wired level. Why in terms of supply and demand or order flow, you would be having better odds to enter here and here and here, and don't just take my word for it. Let's try to reason with it. First, when we have a breakout of a level, we assume that because this was a level hard to break, there were people placing order here saying this is the highest market price for that commodity, for pound versus the US dollar. And so they would be willing to sell at the highest point. With that being said, because there are many people willing to sell at the highest historical level, then they would put a lot of selling orders in it. In order to break selling orders, you have to inject much greater buying orders in order to overflood this and get price up. If this was the situation and in this area there was a fair fight between buyers and sellers, then we assume that there are much more buyers in this area that were not fulfilled with sellers because price gone up. So when price will return here, we assume that they are waiting buy orders that weren't fulfilled from the last war between buyers and sellers. So this would be the reason for why when broken peaks, broken extremes, when price is getting back there, this is why there is this level is wired with buy orders that are being ready for execution. So in a sense of a buying bias, when price will go back here, it will take great amount of buying from historical reasons and price will continue up. Okay, so this is the reasoning for the breakout. The reasoning for this for the origin of the pole. If this was the last time that was buyers and sellers matching up, we can assume that there were enough buyers that wanted to bring price up. There weren't enough sellers, so therefore price went up very, very strong because we see that spike. Okay, so by the very same concept, we understand that there are enough, there weren't enough sellers to cover, to fulfill the buying, the buying demand. And therefore there are leftovers of buying orders. So once price will get back to this extreme, we assume that there are still buying orders waiting here, and therefore price will have a reaction up here. Okay, so again, and for retracement or for deep retracement on a buying bias, this would be a very a reasonable place to buy, because the odds of the order flow is with us, as long as price never came back here before. The decision point is pretty much the same concept, but it's harder to explain for people who didn't go and learn supply and demand. But if we go into lower time frame, we can see the very similar story. We see that price is actually finding its way, and the conviction for buyers to win sellers is not actually at the top of this area. It's right around here, and the driven force to break that level was actually originated from this area. So the decision point will also be wired with unfulfilled buying orders that didn't find enough matching sellers, and therefore once price going back on a buying bias, they will not find, they will find unfilled buying orders, and we expect some rejection here. So again, we're in scalping, we're not looking for reversals, we are looking for rejection, and therefore we are taking immediate moves as much as 15 pips, not greater than that. So this to explain why the flags and the 3 levels that I mentioned will be working. Okay, let me read some questions and see if we are all aligned. Please explain a PIP. I am unaware of the same. PIP is a point in Forex. This is just the nickname for whatever point is in the market. So this is PIP. Can you increase volume? I hope that you can hear me right. Could you further explain breakthrough, the point, the supply demand, order flow in a pullback flag? Okay, I think we've covered this. Samar, if I didn't answer your question already, let me know. How do I identify incomplete flag and identify the upper break point? Okay, so like we said, we have a flag, price is flagging here, and we see that the highest point was not broken, right? So if price, if buyers haven't managed to break this point, the flag is not completed. What can happen here is that we're going to have a reversal pattern, and that will not be a flag, that will be a reversal pattern. And from that, if price will continue going down, it will create a downtrend flag and pulse, like here. Okay, so this is an incomplete flag. We don't want to trade it. We want to trade it as a anywhere because it wasn't really completed. But we can trade prior patterns from the historical, which is this flag, and this flag, and we will have to mark all three levels and decide which one we want to trade. If you want to trade the origin of the flag, we might be missing some trades. If you want to trade the decision point flag, we might get some trades, and if we going to trade the breakout flag level, then we might suffer some deep retracement in our trading, and we'll have to allow much greater drawdown because price can go all the way right here. Another thing that I haven't mentioned is in the theory of supply and demand, we are looking for places where there are supply and demand waiting to be fulfilled. And but there's also, with the very same concept, we have also we are able to determine where are places that have no supply or no demand with high probability. So once price, the theory speaks about that when price return to a decision point, like we see here, that that demand zone is already being taken, and we can consider it as no demand in this situation anymore. So if we see a price that is consolidating like this, that always returning to the region, and from that it's going to going up, once price will go here, there is no demand all around all this area. So there's no demand here, and usually flags are situation where within the flag itself, you beyond the, let's talk about this area, beyond below the decision point, there is no demand. So if price is penetrating this area, it will probably go all the way down here. So this range here, about 37 pips, almost 40 pips, are mostly definite to have no demand in it, and price will easily slide back and taking. So this is can also be considered that if the DP won't hold, you can do a very easy short all the way right here until to the origin of the flag, at least, and take a few pips here. Okay, so let's read more questions. What is a key level? A key level is a level that is very important, and we assume that it would work. Is scalping still effective in a world of high time frame? How would scalpers deal with high frequency trading? Okay, scalping is if you have. I'll recap the question. Somebody is asking if scalping is effective against high frequency trading, and high frequency trading is actually injecting orders into the market. So whatever logic they have to use the very core mechanism of supply and demand in the market in order to move the market. So if you read order flow, you would and you interpretate the price patterns that you see, the candle patterns that you see in, and you interpretate this into order flow language, then whatever happened in the market is explainable, and once you understand the pattern, you can use it. So even if high time frame goes in, they are using some logic, and you can decode it with your human mind much faster than somebody new robot will be. Okay. Few more questions. Okay, there are so many questions. I will not. Let's do a break from questions and continue do some live trading, because we have only 15 minutes to continue, and maybe I'll dedicate some more time for this. So let's look at the Japanese yen versus the US dollar, and we can see that on H1 price was consolidating for a while, and now price is getting down, and here's the flagging situation with for the yen. So with this incomplete flag, price has within all these lower time frame flagging. So at one point we start looking for, we can see after it happens, we can see that price went down. So we can mark these as flags and poles. It doesn't important, because what we want to do is use whatever we've seen in the past to define a future trades. So we see a first flag, and let's mark the levels here. What's that? Okay, so here's the origin of the flag, right? Origin of the flag. Here is the tip of the flag, which is the breakout level, right? Let's mark it. Breakout level. The decision point will be where we see the origin of the little breakout of where price was being able to make a breakout. So the origin of the move that resulted with a breakout, this would be the decision point. Okay, I hope I make sense. So that will be the DP. Okay, so our trade in this one would be to enter with a sell order. Okay, we'll take a sell order. Let me drag it. A sell order for the breakout. Another sell order will be at the DP, and another sell order will be at the extreme, at the origin of the pole. Okay, any of these three should get me some pips in it. For the trade, for the breakout trade, my stop loss, let's put a stop loss and drag it. My stop loss will be beyond the origin. Let's get it? Okay. Actually, for all three trades, the stop loss will be at the same beyond the origin of the pull. Okay. So if this is the stop loss here, we'll set stop loss for this one at the same level. Okay, so in terms of scalping, the breakout trade has the greatest risk of all. Okay, now it's risking about almost 25 pips, and we expect to take only 15, right? So 15 is around here, and we have the breakout. We have the decision point, which is risking only 13, and we have the origin which is risking 5 pips. That would be our scalping. So we have three trades that not all of them will be giving. Maybe it will not go to the extreme. So we'll have to cancel that limit order at one point. And but this is actually the only flag that is retraced. This is an ascending flag, so I don't really want to trade it. It's not giving high probability. Let's see if we were at the right time, how that would be working. How would this flag would be working? So let's mark the level. So here's the region. Okay, the region of the flag. Here's the decision of the decision point. Hold on. What's going on? Okay. Okay. And there's the breakout level, which is here. Okay. So let's see what happened. Once price went back to the breakout level, it could be considered as consumed because price was already touching, but let's consider it's not and it came fresh. So we were taking 13 pips, 13.4 pips in drawdown, and price went down about 17 pips. So with spread, that would have given us our 15. So we won that trade. Then price went to decision point, and in decision point, remember, we are risking 45 pips. Okay, we had a drawdown of almost 10 pips, and price went down and gave us 20 pips potential. So we would be taking our 15 pips in win. And then at the origin of the pole, right? The origin of the pole, if you're not clear with it, this is the pole, this is the origin, okay? Then we enter here, and price went 28 pips, almost 30, and then returned back to 23, 38. That would definitely give us the 15. It had a very deep drawdown, but it didn't get to the 40. So we won 3 trades trading this flag before. So this flag on the yen, if you can mark it, let's talk about this next week, and we'll see if this flag had worked for us, yes or no, if it was giving us 15 pips versus So you see, with that flag, we were already taking 3 trades, and if we were busted with 1 trade, we would be already break even. So we are at 66%. We have locked 66% success already by doing so. Okay, so be aware of that table of the risk reward ratio. So we have 5 minutes more, so let's read some more questions. We have a question from Muhammad. When will the falling flag gonna consider a reversal of the trend direction? So when you have an incomplete flag, okay, you see here we have a pole, right, coming from here, and we have a descending flag right here, right? But it's never going to break that level, and it continue up. Now it had an impulsive up. Let's go there. It had an impulsive back, and it created a new flag, and it's still not breaking that lower point, right? And then another, this is a low time frame flag, and now we see another flag coming up. This is a ascending flag. Okay, so we have a flag. This is an incomplete flag. This is incomplete flag. So we don't have a conviction yet for this flag, for the upper flag. This one was definitely not completed. So we can consider this as a reversal in terms of understanding the bias. Okay, so I hope that answers you. So Subu asked if it's advisable to enter the trade in the opposite direction of an incomplete flag. I would say never deal with incomplete flags. Don't trade them unless you have learned something and you have some understanding and insights about the incomplete flag anatomy, and you have some way that you have tested. But from what I understand, I don't deal with incomplete flags. There are so many flags out there. I don't need to play with complex patterns. How far in the past do you go and pick trends and break up levels? I would, the Japanese yen is a very good example to show you. Whenever we are here in real time, in candle zero, so-called, we see that price is going up. And then we are looking for the newest fresh levels that weren't being tested before. So we know the next level where price will go. We expect that this level will be the next play. So this is where we want to work. Once price will, let's say, break all this area, then we would go as far as to these flag and poles area. And if that was broken, then we would go much further to the history. So as much as we have void space, we would go and look for the fresh, untouched areas. Okay. How does the middle flag? How does the middle flag doesn't work? I don't. Uh, um, First, there is a question for somebody anonymous. Why does the middle flag not work? Um, Not all the flags will work and not all the patterns will work. When we deal with trading, we assume, we know and we understand that sometimes our patterns will not work. Therefore, we have to have our solid risk management, because once we're in a trade, we are working once we're in a trade, we are working with the unknown and with the unexpected. So the game is risk management. So this is my answer for you. We don't expect all the formations to work. We manage risk upon them. Um, Desiree Gonzalez asked, where do we placing the profit target, or we're not using it? Yes, we are placing targets. Like we said, we define that how many pips we want to take, how many pips we want to risk. We don't play with it. We take as much as we decided we take, not more and not less, in order to maintain the right risk and ratio that we have defined. And this would be the easiest way to also create your own statistics and know that if you are on the right venue to be consistent. A tick chart or hour chart for scalping, you you define the levels on H1 and up, and you can trade whatever chart you're comfortable with. It can be tick chart as long as you see the levels. The levels are wired. If you define your levels on H1 and then you go to M15 or M5 or even M1 and refine these levels, that can be giving you better precision. So whatever you're comfortable with, I'm just teaching the concept here. Fibonacci circles work or not? I have no opinion about Fibonacci. I'm not using it, so I cannot say anything about it. Can you explain more how to identify flags and poles, please? In a second, I will. Any indicator you suggest for intraday trading? No, I'm not using indicator. I'm using pure price action naked charts. I think this is the best indicator of all to see price and understand it. Camilio asked, do you draw the flags points and then on the next move you will enter? Will you enter, for example, as soon as the breakout is broken? No. We are plotting formation that were completed, flags that were completed, and only once the flag is completed, we can create our levels. And then once price return to this level, let's see this. We have this flag. It happened on July 23. And now we are waiting the next levels that we all wanted to be scalping for the US dollar Japanese yen is once price is going to back here. And so we have three key levels within this flag. And because this flag was completed, we know what is the order flow situation in it. And this is how we can manage risk inside. And so we are analyzing completed patterns, and we will be trading them once price get back there. We won't trade a blind breakout because there are so many fake outs. Here's a fake out another fake out, price is breaking this level and faking out. You never know until the pattern is complete. So the pattern will reveal to you whatever the order flow situation in it only once it happens. So there's enough scenarios that you can actually use using the historical data that price provides you. So once more, let's recap and see how we can draw some more polls and flags. Let's find. Okay. Sometimes you have to go on higher time frame or lower time frame to see clear view. Okay, now price is going down, is on a downtrend, and we're going to look for two scenarios. One scenario on the Kiwi, right? New Zealand US dollar. So we are going to look for reason to sell if price go up and reason to buy if price goes down. Okay, so I really use condensed charts, so bear with me. Okay, so we see flag up here. We see ascending flag here. We have this flag here. Okay, the pole is not really important once you draw the flag. Okay, and there's nothing to do here. This is a lower time frame flag. We wouldn't want to trade it. So we see that price had already gone. Let's mark this. So here's the breakout level. Here's the decision point right here. And here's the origin of the flag. Okay, we see already price hits the breakout points and the decision point. With all of these, they were giving, I think, our 15 pips. That's fine. Still yet to come is the pole origin, okay, at this level. So we can take that for sure. The next flag will be the breakout level right here. Let's delete this. Decision point is pretty much around here. Maybe we should go to lower time frame to refine this. Maybe it's somewhere around here. We don't mark it at this situation, and we have this origin of the pole. So we have two levels for this flag here. This origin of the pole is also the breakout level for this one. So we can assume that if it's the same level, this level is already been consumed. So we don't want to trade this one. However, we can use the decision point of the upper flag and the origin of the pole. So we have another two levels right here that we can take short trades. In terms of when we expecting long trades, let's cut this. Okay, we have a very long pole. Sorry, very long formation for flag, which is something like this. Usually I wouldn't want to trade this kind of formation. This formation was already this is an incomplete flag, so we don't want to take it. The only level that we would be expecting here is the decision point here. and maybe the origin of the pole for this one, and the breakout level here. Okay, so here we have a lower time frame flag. We don't want to consider it at this point. We have ascending flag, and then we have a flag here which is incomplete. This is all area is incomplete. So we actually have three reasons to three buy entries for the upcoming time. So these are the levels. These are the levels that we would consider to scalp for the Kiwi. We can continue using the same logic, same very simple logic to continue draw flag and poles, looking for the decision point, the breakout point, and the origin of the pole. And we have three different entries for each flag that we can actually take. It's very, very important that you maintain the risk-reward ratio. Otherwise, you will not be making consistent trading. So let's start wrap up everything. So again, thank you for showing up, and I hope you find this webinar valuable. And remember that we are the 5percenters.com. Take a visit to our website and see what we offer to consistent traders. Maybe for it can work out for many different trading styles and different trading skill levels. So go up and look for it. And I really thank you for showing up today. And if you have any more questions, we'll be very happy to assist you. You can write me to helpdesk@the5ers.com, or you can just go to our website and find more valuable information in our blog and the articles that we are writing about trading management, risk management, mentality. I think it's a wonderful blog out there. We have a good writers that that share their experience. So take a visit, write me, and we'll be meeting next week the same time, and we'll continue discussing new ideas for how to use price action and order flow understanding in order to scalp and taking pips from the market. So thank you so much for being here. We'll have the recording up there in our YouTube channel, so you can see our YouTube channel also on our website. We will have a link there. And take care. Go and practice on demo. Do back testing on this very concept. I promise you, this is going to reward you very well once you get your grip on it. So thank you so much. Have a good evening wherever you are. Bye-bye.